Welcome to Sri Shankarasana classes. In this session, we are going to learn about how to prepare the cash from operating activities. Basically, while you're preparing our cash from operating activities, first step we should bring down the net profits available in the question, either by the difference or given the adjustments. After that, we need to pick the non-cash expenses in the nature. That means non-cash expenses in the sense means the expenditure should not demand the payment. The expenditure should not demand the payment in cash inflow. So what we should do, we should add back all non-cash expenditures. After that, we should deduct non-operating incomes. Non-operating incomes in the sense means that it is not a regular incomes for the company. So all non-operating incomes that we should deduct from the following. So we can get net cash inflow or outflow of operating activities. After that, very important, we should make adjustment of current assets and current liabilities. And while we are taking to current assets, you should not touch any cash and cash equivalents. And you are taking in the current liabilities, you should not touch bank overdraft. So any increase in current liabilities and decrease in current assets supposed to be added, and increasing current assets, decreasing current liabilities supposed to be deducted. So after that, any income tax paid available in the question that are deducted. So finally, we will get cash from operations or cash from operating activities. If it is positive inflow, negative outflow. So let us go with the question to find out only the cash from operations. So first step, we should look at the profits available in the question. So net profit is available here. So that we should bring down net profit, and after that we should pick non-cash expenses. So salaries is a cash expense, rent is a cash expense, so depreciation is a non-cash expense, and because decrease in the value of asset but it not demand any of the payment, so depreciation is non-cash expense. And loss on sale of plant, again loss on sale of plant is also a non-cash expense. And goodwill written off, it is also a non-cash expense. And proposed dividend, but dividend declared but not yet paid, so again it's a non-cash expense, short back net profit. And the provision for tax, I think the provision made during the year, so again it is also a non-cash expense, is supposed to be added. So first time, from the given information, we have to identify which is the cash expense, which is the non-cash expenses. So we should only take the non-cash expenses into account from the P&L account. And we look at right side of your P&L account, have profit on sale of land. Again, it's non-operating income in nature. And moreover, the profit is already recorded in the sales from investing activities. So we are going to deduct profit from sale of land. And income tax refund is not a regular income, so we are going to deduct that one also. So from the P&L account, only the thing is we need to extract the data relating to the non-cash expenses and non-cash incomes. So it starts with net profit. What is given in the question? 10,000. For that, add non-cash expenses. So non-cash expenses, the basic knowledge of the terminology itself will give us a little clarity about which are the things that should take into account or not. So depreciation is a non-cash expense, taking into account. Depreciation 2000 over there. And the loss on sale of plant is again a non-cash expense, so we take into account. Loss on sale of plant, we have 1000 in the question. Then goodwill written off, again it's a non-cash expense. Goodwill written off, we have 4000. And proposed dividend is a non-cash expense, is supposed to add that one also. Proposed dividend 5,000. And provision for tax Also non-cash in nature, because any appropriation of any transfer to reserves or transfer to provisions means the real, when you analyze the transaction, the funds are within the firm itself, does not have any outflows. So any provision or transfer to reserves is supposed to add back to the given net profit. So provision for tax, $5,000. So overall it will be 17,000. And less or deduct non-cash incomes or non-operating incomes. So here we have a non-operating incomes, profit on sale of land. So any profits on sale of non-current assets treat as non-operating income. Any loss on sale of non-current asset treat as non-cash expenses. So profit on sale of land is a non-cash income. You're supposed to deduct that one. Profit on sale of land. We have 5,000. And income tax refund is not a regular income. So again it is non-operating in nature. So income tax refund. We have 3,000. So overall 8,000 that is supposed to deduct. It's 27,000. 27 minus 8. It's 19,000. Positive means net cash inflow. From operating activities. Net cash inflow from operating activities. So in case if any current assets and current liabilities are in the question, that we have to take next step to adjust the current assets and current liabilities, and the income tax paid is there. This also you have to deduct from the cash from operating activities. Finally, we'll get net cash inflow or outflow from operating activities. The major adjustment here is adjustment of current assets and current liabilities. Let us discuss one simple sum on that. Current assets and current liabilities. See, in this question, we have a list of current assets and current liabilities, and we have to adjust it to net profit to find the cash flow from operating activities. So first step, as usual, we have to take the profit made during the year. They have given 2 years information, opening and closing. So closing minus opening, it will become same, 2,50,000 profit made during the year. Profit made during the year 2,50,000. And we have adjusting of only current assets and current liabilities here. So while taking up current assets into account, we should not going to touch any cash and cash equivalents, and current liabilities we are not going to touch any bank overdraft. So first, what are things supposed to be added? Increase in current liability and decrease in current assets should be added. Increase in current liability and decrease in current assets should be added, and decreasing current assets and increasing current liability should be deducted. So first, supposed to be added increase in current liability and decrease in current assets. Increase in current liability and decrease in current assets should be added, and less decrease in current liability and increase in current assets. So I have to remember these two statements. We are taking adjusting of current assets and current liabilities. So first start with one by one. So income received in advance. So income received in advance, something but current liability. So any income received in advance treated as current liability. So income received in advance, the current liability. So opening is 2013 is the opening and 2014 is the closing. So 600, 500. Decreasing current liability. Decreasing current liability. So a decreasing current liability should be deducted. So should write down. So income received in advance, current liability, income received in advance. So income received in advance, the current liability. So opening is 600, closing is 500. Decrease in nature, closing minus opening, 600 minus 500. So you're supposed to write 100 under the heading of decreasing current liability and increasing current assets. So I have two headings, and look at the next one, prepaid expenses. So prepaid expenses is the current asset. So any expenses paid in advance until unless the activity realizes, we can treat as a current asset. So prepaid expense is the current asset. So opening is 1400, closing is 1600. So increase in current asset. Increase in current asset. So any increase in current assets should be deducted. So current asset, prepaid expenses, prepaid expenses. So opening is 1400, closing is 1600, closing minus opening 200. Closing minus opening, you should get 200. Look at next one, debtors. Debtors is the current asset. So opening is 95,000, closing is 80,000. It's decrease in nature. So any decrease in current asset, should be added. So current asset, debtors, opening is 95,000, closing is 80,000. So difference between closing minus opening is 15,000. Next we have to say bills receivable is the current assets. Again opening is 20, closing is 25. Increase in current assets. Any current asset supposed to be increased, deduct, decreased, add. So here the bills receivable is increase in nature. So opening is 20,000, closing is 25,000. So it's increase in nature, it's supposed to be under deducted. Current asset, bills receivable. Bills receivable, increase in nature, 5,000. Look at next one, creditors is the current liability. So opening is 40, closing is 45. It's increase in nature. So increase in any current liability is supposed to be added. Creditors is the current liability. So 5,000, closing minus opening, 45 minus 40, it will be 5,000. Look at next one, bills payable is again current liability. So opening is 15,000, closing is 13,000. So it's decrease in nature. Any decrease in current liability is supposed to be deducted. So bills payable should be deducted. It's a current liability. Bills payable, decrease in 2,000. And we have outstanding expenses. Outstanding expenses, occurred but not yet paid. It's supposed to be paid, so it's current liability. So opening will be 2,000, closing will be 2,500. It's increase in nature, so increase in current liability is supposed to be added. Outstanding expenses, 500. Then we have accrued income. Accrued in the sense certain fixed incomes, default incomes like interest on deposits, so that we know that income is going to realize in the next day or next month. So those kind of incomes, what we call it as accrued incomes. So accrued income is a current asset. Accrued income is a current asset. So opening is 1200, closing is 1500. It's increase in nature, so increase in current assets should be deducted. Accrued income, so difference between closing minus opening is 300. So make a total of decrease, increasing current liabilities and decreasing current assets. It's 20,500. So 2,50,000 plus 20,500, 2,70,500, and total of this will be 7,600. So deduct now, we should write in bracket. So 2,70,500 minus 7,600, 2,62,900. So cash flow from operating activities. So an income tax is paid is there, that you have taken the next line into account. Thank you.